practice or are you running a business? Valuation is the ultimate KPI.
Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast, brought to you by Truelytics by Envestnet. This week on the show, I have David Wieland, founder and CEO of Realize, with me. Realize is an investment property wealth management firm that is helping financial advisors tap into the last segment of the household balance sheet. Now, if you have followed this show for any length of time, you know that I love to nerd out on this type of topic because, heck, one of the reasons why we named this show the Modern Financial Advisor Podcast was because I saw the need to help advisors reimagine their business and the services they offer to fit the new realities of the modern world. And in this episode, we are going to be diving deep into that concept. Now, before we get started, please make sure you subscribe to the podcast on Apple Podcasts, Spotify, Google, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest for the show, hit us up. Swing by Truelytics.com and use that little contact form there, or shoot us an email, podcast@truelytics.com. Okay, let's get to the conversation with David Wieland. Well, David Wieland, so wonderful to see you. Welcome to the Modern Financial Advisor Podcast.
Thanks, Mike. It's great to be here. I'm really excited about this. Been looking forward to it all week.
I'm totally pumped for this. This is fantastic. You know, I actually feel a little bad because you're in Austin, Texas. I'm in Austin, Texas. We actually should be sitting around a table recording this in person, and that's kind of on me. But next time, absolutely, same room. It'd be great.
Well, with this weather in Austin before it gets hot, we
Yeah.
should be sitting outside. We should be like at Barton Springs right now. We should do it there.
Dude, I'm getting ideas. Outdoor podcast. This is going to be fantastic. Now, you're going to see a radical change in the way that our shows are produced. Like, where are you guys? Yeah, we're out in the park somewhere, just sitting here recording podcasts. I've actually never recorded a pod outside. So now you're giving me ideas, bro. This is going to be great.
If and when you're ready, I'm your person. I'm your guy.
There you go. There you go. And, look, I also encourage, we include some beers. Look, everything goes better with beer. So fantastic stuff.
So
Anyways,
we're going to have a party that we do a podcast at some point.
this is absolutely. I've done this a lot of time. By the way, I've done lots of podcasts and streaming video stuff that have had beers. It's why not? Recreational beverages, as I like to call them, makes
Yeah.
everybody, well, we're all a little more fun.
There you go. A little looser. Well, it's great to be here, Mike. Thank you so much.
My pleasure, and I'm super thrilled that Trey put us together. This is going to be an amazing episode because I'm particularly interested in it because there's not too often that we get to talk about what we're going to be hitting on today, which is really expanding the opportunity for a financial advisor to serve their clients more holistically. And so I'm really pumped about that. So let's kick things off by diving into what you've termed the last segment of the household balance sheet for financial advisors to manage and advise for their clients. So, what do you mean by the last segment of the household balance sheet phrase?
Yeah, good question. So when you look at household balance sheets in the United States, and this is coming from the Federal Reserve Survey of Consumer Finance, and you look at households over the age of 55. So let's just call those baby boomers for right now. So when you look at the wealth of baby boomers, what you see is that they have somewhere between 11 and 12% of their total net worth in investment properties. When I say investment properties, what I mean by that is any property held for investment other than a primary residence. It's sort of defined by the tax code. So 11% of their net worth in investment properties, that's about equity of about $6.4 trillion. And so that segment of the population, it's really unique. They're sort of hiding in plain sight. They've built wealth a different way through investment properties. They may be white collar, they may be blue collar. They're the millionaire next door. They probably bought one rent house and then another rent house and then a duplex, or it may have been the office building that their business used to be located in, or it could be a ranch or a farm, whatever that is. They're multi-millionaires. And when you talk to them about financial services and in particular wealth management, they are either under-advised or unadvised. And it sounds crazy to probably a lot of your listeners, but we'll run into families who have $5, $10, $20 million worth of wealth, and they don't have a financial advisor. So think about that. I mean, maybe they
Yeah.
have someone to manage their 401k. So these people who have built wealth a different way, and now they're in retirement, so they're moving past accumulation to hiring, and what they need and what we are creating at Realized is an opportunity to connect real estate and fit it into wealth management so that wealth managers can manage their clients' portfolios holistically. Well, a lot of times what we see is they're sort of managing around the donut hole in the middle, which is investment properties.
Yeah. That's fascinating. And I want to dive into kind of like how this comes to be and like that a financial consumer, if you will, or a person has so much wealth in investment properties, yet lacks any functional financial advisor in their life. But let's talk more about the financial advisor first, I think, because it's interesting. I've often talked about the need for investment advisors, specifically RIAs, to expand their business to other investment advisory areas beyond stocks, bonds, and mutual funds. And I get it. They're licensed as an RIA to provide advice and charge a fee for that advice by either a state regulator or the SEC. And that's kind of the what their business has been built upon. However, I've often, similar to what you're talking about, made the argument like, listen, you're missing a lot, right? There's a lot of things happening. And especially when you're talking about high net worth and ultra high net worth individuals, they don't just have all their wealth concentrated in marketable securities. They have investment properties. They have investments in other small businesses, maybe some sort of other alternative type of stuff. So why do you think it is, beyond, I guess, their licensing that so many financial advisors aren't looking at real estate as an area where they want to advise clients?
Yeah, it's a great question. I'll give you a funny story that was sort of the genesis for Realize. This goes back about 2007 in my last company that I started. And I personally, through that company, owned a lot of real estate. It was about 60% of my net worth. It was
Mm,
not a technology company or even a wealth management company, real estate company. So I owned a bunch of real estate. So I was sitting down with my financial advisor, I have incredible respect for. They still do work for my family. And I said to him, CFA, head of the investment committee, I said, look, I'm looking at, we're in their office doing an annual review, and I'm looking up on the screen and I say, great, I see all my liquids, my insurance, my house, this, that. And then I see real estate, literally 60%.
hmm,
And this is all kinds of real estate that I put together through this company. And I said, what should I do with my investment property?
hmm.
And he looked at me seriously and he said, diversify. And he did it with hesitation, and it just hit me like,
Hmm.
oh my gosh, this is insane. I mean,
Yeah.
that's the majority of my net worth. And you are a fiduciary and you're doing a great job holistically, except for 60% of my net worth. And and it just struck me, and I started thinking about that, and that was sort of the genesis. And I think that the reason that wealth management and real estate don't talk, there's a lot of reasons here.
Yeah.
um, and I want to be very careful not to offend anybody listening to this podcast, whether they be on the real estate side or the wealth management side. Wealth management doesn't understand real estate, and real estate doesn't understand wealth management in
Interesting.
general. There's
Yeah.
certainly exceptions to that, but they don't. And so they
Yeah.
don't talk. I mean, they literally speak different languages, and we are working to overcome that challenge. We've actually created the technology to do that and a service offering for RIAs, fiduciaries.
Yeah. It's funny. I By the way, it's not offensive because I've said this stuff on the podcast all the time. So maybe let me be the one who offends people. Here's the deal. This is a fact that I know, and I welcome our people that are RIAs in the audience and financial advisors, independent financial advisors, to tell me I'm wrong. It'd be great to have that type of engagement here. Most financial advisors, at least half, I would put an argument to forward to say they did not study finance in college. They were not finance majors. Most financial advisors got their start as stockbrokers. They answered an ad somewhere to come work in this industry, become a financial advisor, be a stockbroker if they've been in the industry for 30 years or so. After that, it started to become financial advisor. They get trained in the space, but they get trained in the space to sell stocks, bonds, mutual funds, maybe insurance. That's where their licenses are, and that's where their education came from. They did not go through a finance education in which they learned how to evaluate real estate deals, right? Like, what does a real estate deal look like? How do I, handle the income from that? How do I handle depreciation, right? Like, how do I handle all that type? How do I find the right deal and work it into like, so they don't even know things about, we're going to be talking a little bit about 1031 exchanges. This is not part of their lexicon. It doesn't mean they're idiots. It doesn't mean they're dumb or bad financial advisors. It just means they don't have the education for evaluating and analyzing these types of deals. And so it's kind of out of their wheelhouse to advise on that stuff.
Yeah, I would agree with you 100%. And I would share with you on the other side of it, because I've spent 30 years in institutional real estate with REITs and insurance companies, my own companies that I have started. And I will tell you, real estate doesn't understand wealth management for a lot of the same reasons.
Yeah.
You have people who came up as they started as analysts, or maybe they started doing tenant rep work as brokers, but they learned the real estate business. And so by the time they get to a certain age, we're literally speaking different languages, adjacent industries that don't talk with one another. And it's truly bizarre, but it is a blue ocean opportunity that every financial advisor, every wealth manager in the country should be aware of. And that's what we're here to talk about.
Yeah, absolutely. And it's funny. That's the context, right? So for any RIA or advisor who's listening and going, I think I'm offended by what Mike said. Don't be. We're talking about opportunity here. If what I said is true and if what you're saying is true, and we both have a strong conviction that it is, what this means is this is an opportunity for you and your business, because most financial advisors, frankly, just aren't going to do the work to expand their skill set to become knowledgeable about advising on real estate, just as most of them won't get knowledgeable about advising on crypto or investing in startups or other asset classes that are outside of the typical universe of what they advise clients to look into.
I think that's very true. Now, I would just add to this because this is very interesting to me. I tried as a real estate professional, as a syndicator developer, I tried to work my way into the wealth management industry. I spent probably 7 years. I had wholesalers, and this is when I was in the direct real estate business. So I was doing my own syndications, which is different than what I do today. But I spent time trying to break into that, and I literally just banged my head against the wall. And I realize now why. I was trying to teach wealth management about real estate. I was using my own terms. I was using jargon, cap rates, effective rents, these terms that I know. And it all of a sudden hit me. If we're going to be successful at this, we need to fit real estate, investment properties in particular, into the lexicon of wealth management. And we need to build technology that makes real estate look like every other asset class. So inter-asset optimization, intra-asset optimization, consolidated reporting, rebalancing, annual reviews. So drinking from a fire hose I'm kind of a recovering real estate guy who has learned a ton about wealth management in the last 7 years building this company. But that's the whole idea is I'm going to talk to financial advisors, planners, RIAs, fiduciaries in a way that is consistent with the business that you're in. And that is what we're doing at Realized.
I like that. Let's dive into that a little bit deeper there, like kind of filling in these gaps as you termed it in our prep call. You're like, hey, listen, there's some gaps that need to be filled in. But I imagine there's going to be a process behind that of doing that, right? I mean, so you've built the solution, but what is the process for helping advisors fill in the gaps, the knowledge gaps, if you will, so they can better serve their existing clients and then maybe, hopefully, win new clients, right, in the process with their new capability? Because to me, that's, listen, I want to be able to serve my existing clients, but if I've had clients for a long time, they're sticky. They're most likely not going anywhere. What I really want to do is expand my business either by increasing share of wallet or hopefully bringing on new clients with this new capability.
Yeah. So make no mistake, what we're talking about here is forward thinking RIAs who want to grow and differentiate their business.
Yeah.
With a blue ocean, a $6.4 trillion blue ocean opportunity with baby boomers. Mm-hmm. It sounds like a layup. Yeah. So there's a couple of things that we've done. How do we do this? So the first thing is Realized owns a broker dealer. We own an RIA. We have compliance in-house, and we've been inside of financial services and securities business for the last 7-8 years, and actually for some years before that. So that's where we come from. So we're not walking in and saying, we're in your space to begin with. The second thing that we have learned is we have built a number of mechanisms where investors with even relatively small amounts of capital relative to real estate. So say they have 250 or 500,000 or 100,000 or $5 million to invest, where we can get them very, very meaningful diversification across portfolios. And that's really important because $5 or $10 million or 50 million sounds like a ton of money, and it is. In real estate, $50 million is one Class A apartment complex.
Yeah.
So it's hard to get diversification. We've solved that problem. And that's the first one. And more importantly, and this is the reason that I think real estate and wealth management, financial services in general, have not necessarily talked, is because there has been until now no scalable, objective way to quantify risk of individual investment properties. That could be a rent house, or that could be an office building, or that could be a shopping center. To be able to quantify risk at the property level, that then rolls up to the offering level, that then rolls up to the portfolio level. So let me give you an example. You walk into a fiduciary's office and you say, "Hey, I've got a great real estate. I've actually got two great real estate deals. I've got one, and it's sort of got an expected, return of 8%, and I have another one who's got an expected return of 10%. Which one should you do?" And they go, "Well, I don't really know how to quantify risk.
Yeah.
So let's just forget about that and let's go with the 10."
Yeah.
Like, this is not the way that just wealth management makes that decision. That's how real estate guys make this decision. Literally, there's a kind of a gut feel. You do some due diligence. That's how you do this. And so let's level set and let's have risk metrics that work across the industry. Realized has developed those risk metrics. We just put it into the market in January, but I've actually been working on this for 30 years. I started this in graduate school, so 30 years of my work inside of pension funds, coming up, working for pension funds and REITs and companies like that, my own companies, developing a risk methodology that's scalable and objective, and it works for all investment properties. Quantifying risk so you can compare after-tax returns.
Yeah.
You can compare risk-adjusted returns. You can look at your diversification and covariance and correlations, and you can look how you're using portfolio theory to see the benefits of a particular asset class, in this case, direct real estate or investment properties, and how it's affecting your overall portfolio, obviously low correlated assets. So that was the first thing. I think that's why I truly believe that that's how real estate and wealth management never talked, because they didn't speak the same language, which is risk.
Yeah. So first of all, I'm going to have to connect you with Aaron Klein, the CEO and one of the founders of Riskalyze, which soon to be changing their name. If you haven't connected with him already, I had him on a podcast a few episodes ago. Fantastic guy, and they might be very helpful in translating the risk you're talking about into a tool that is used widely by financial advisors for risk communication with their clients, right? Understanding. So that might be a really good connection. But while we're on this topic of risk, help the audience and me understand some of the risk elements inherent in, obviously not giving away the secret sauce of how everything works, but like, what are some of the core risk elements when I think of when somebody's approaching or evaluating investments in real estate and how that relates to the rest of their portfolio? Because we think about stocks, bonds, mutual funds. You're thinking about the beta of how much does it move in relation to the rest of the portfolio and the like. What are you seeing here in terms of real estate risk?
Yeah, it's interesting, and there's so many different kinds of risk in real estate, but I'm going to speak to specifically the way that we think about it as investment property wealth managers. So the way that we do it, and foundationally, the way that our risk models work is they look at historical volatility of particular types of properties within particular geographies. So let me take an example. You're in Austin and I'm in Austin. Let's look at Class A apartments. So that is, sort of 4 or 5 years old, institutional quality real estate, and how they have performed, not just in Austin, but how they've performed in the submarket where they're located in. So just to be, just for a real world example, let's talk about how Class A apartments have historically performed over the last 10, 20, 30 years in the Arboretum area of Austin, or in the Buckhead area of Atlanta, or in the Inland Empire in Orange County. So you look at those first. You look at the rent volatility, because at the end of the day, in real estate, you're a price taker. It doesn't you can always say the different, but if you're a price taker. So whatever the rents are doing is what you're going to do. And so we look at the volatility of that, and then we actually run it through cash flow models, where what we're measuring is the risk to the individual investor who's invested in that deal, that offering, that portfolio, that they are going to get the income that they expected,
Mhm.
one. And then secondly, what the appreciation potential is, both downside and upside. So, what's the likelihood that you're going to get your capital back? Secondly, what's the likelihood you're going to get more capital back? So, income plus appreciation, total return. So, we're optimizing again, specific to the investor, specific to the location, specific to the property or portfolio of properties that they own, and using that to then come up with a measure of overall risk of the portfolio. If you think about this, this is exactly the same as you would do with stocks and bonds. Let's look at a stock, or let's look at a sector, historical volatility. Okay, we're looking at beta. Let's get a little bit more technical. Let's put it through sort of a structure, which is the company, and see what that does and what it means for the dividend risk. Let's
Mm.
see. I mean, it's the same approach. Think about bonds. You've loaned to somebody, they've got some credit rating. Well, the rating agencies are out there and they're saying, what is the likelihood that this individual or this company over here is going to pay their debt, and that they're going to be able to repay it?
Mhm.
Because that's in essence, I mean, this methodology is not new. It's quite the opposite. It's exactly the methodology they use in every other asset class. So when you do it that way, then what you start doing is you say, okay, again, what are the correlations, covariances between
Yeah.
various properties, markets, submarkets, sponsors, and you start looking at your portfolio on these dimensions. It's just logical. It,
Yeah.
it's it's intuitive. We're talking to lots and lots of RIAs, some very large firms right now, and they're saying, "Oh my gosh, I understand it for the first time." You are the first real estate person who has ever talked to me like a fiduciary.
Interesting. You know what? You just brought up something that I really need to I want to dive into because I want to understand it a little bit better. And it just kind of makes me think about how this might transform an advisor's business. So real estate as an asset, as an investment, performs and behaves differently than, again, stocks, bonds, mutual funds, right? A- At its heart, it's an income, right? I mean, you do see some speculative real estate
Hmm.
investment. People buy something and hope that it appreciates in value. But by and large, people buy real estate investment property because they want it to generate income. Now, that income is different than other income. It's, as a general rule, passive income. It also has the ability to have depreciation on the property, which can lower your taxable income, right? So there are some things that operate a little differently. Now, I imagine when I plug that into, especially if it's big enough, a big enough chunk of my wealth, into a traditionally managed RIA relationship, it might change the dynamics or open up new opportunities of how I manage that portfolio. I can either, and I'm just going to brainstorm in here, risk up that portfolio, knowing that any gains I take, I have this depreciation that will lower my taxable income, so I could be risk on a little bit more in that portfolio. Or I guess it could be less risky, like knowing, like, listen, I've checked a box on retirement income. I've checked a box on other things here. Therefore, I don't have to be as risky with my equity positions here that I'm looking for growth. I don't have to be like swinging for the fences or whatever. Have, in the work that you do with advisors, are you having these types of conversations about like how might this transform the way you do business?
Yeah, absolutely, absolutely. We have different advisors who have said to us, it's too early to tell. Again, we've been rolling this out to the advisor committee or the advisor community for about the last about 3 months now. But we've had a couple of very candid conversations with advisors who say, I want to use Realized to actually specialize my practice. Or this is a huge growth component because I have an existing book of investors who have investment properties, and I can actually give them that holistic view that I've never been able to. Or they're saying, um, you know, I know some real estate professionals or people who have real estate who I've never approached because I didn't have a solution. Or
Mm.
there's sort of another approach which is very, very interesting, and that is Realized is approaching about $1 billion in AUI, or AUA, and so we've been working that has come direct to consumer. Just we built our business the same way that any RIA or broker dealer would. But as we get in and we've done multiple, now we're managing investment property wealth for a number of families. We've got about almost 1,000 clients out there, and when you look at who they're advised by, under advised or non advised, and they're saying to us, "Hey, could you help us find an advisor? Because we now understand, thanks to what Realized has shared with us, we actually need a comprehensive plan. Do you
Mm.
guys do comprehensive plans?" To which we say, "No, we do investment property wealth management. That's all we'll ever do." But I've worked with XYZ RIA, who's very good in your area, and can I make an introduction? And what that leads to is a new client relationship for the RIA. And we've seen a couple of our IARs who've come back to us and said, "I did a $2 million exchange with a client, or a $2 million transaction with a client. We worked through that as an RIA, and in the last 6 months since then, they bought they brought another $8 million under management, insurance, and now we're building a comprehensive portfolio to transition them out of their highly concentrated real estate portfolio into a more comprehensive portfolio." And are we good with that as Realized? It means that we're losing part of our clients, but that's great. This is
Yeah,
all about paying it forward. If the client wins, we win, period, always.
that's fantastic. I love it. I love it. Let's talk about how the mechanics of this stuff works, because it's a you hit it sort of at the high level there. Like, about a client comes to you, they have real estate, you're helping them with the process, and then you refer them to an RIA, right? And I think part of doing podcasts like this is to expand the network of advisors who are working with you there at Realized. What's the mechanics for how Realize works with, let's just say you mentioned that client might have $20 million of investment property or what have you. They come to you. Uh, what does this process look like? And then how does it fit in with the advisor's business? Like, take me through kind of like the whatever,
Sure.
the mishmash of how this works.
Sure, and here's the way it typically works. Again, remember, we're focused on families over 55.
Okay.
So they've already got what we call the investment property wealth problem
Hmm.
in air quotes.
Yeah.
But I mean, they're there and they're looking to do something different. They don't want to be the landlord. They want passive income. They want divisibility, estate planning, all those things that most baby boomers are talking about and advisors are talking about with their clients. So they'll come to us and say, "I'm thinking about selling one or multiple investment properties that I own." Okay. So we start working with them typically before they've sold that, but they've already made a decision to potentially sell it. Maybe they haven't listed it yet. We start talking to them about what they want to achieve. And when I say we, it doesn't matter whether Realized is talking to them directly or an advisor is talking to them directly. I'll talk about the Realized solution and how this works. But you start having a conversation. They say, "I'm going to sell that," which immediately leads to, "Okay, have you looked at your tax consequences?"
Mm.
Because real estate enjoys tax advantages that literally no other asset class has, and it has for pretty much the entire existence of this country. It's always been tax advantaged. So what you start looking at is that they probably have capital gains and depreciation recapture on that real estate. That if they're somewhere in a high tax state, if they're in California, Massachusetts, Illinois, their effective gains rate on the capital gains can be 40-45%. You sell something that you just made $2 million on, and the IRS is going to take 40% of that. And people go, "That's impossible. You can't go above that, the marginal tax rate." Yes, you can. It's because of depreciation recapture. So,
Yeah.
so that's what happens first. And they go, "Well, I don't want to do that." So you go, "Great. let's talk about a 1031 exchange, which is, I don't want to get into the technical part of this, but effectively it means there's a rule out there under the tax code that says if you adhere to certain rules, that every time you sell a property, an investment property, as long as you reinvest in one or more properties in a very short time frame, and you hit some certain rules, that all the capital gains are deferred, not eliminated, but deferred. So it's sort of like a 401k. You put pre-tax dollars in, eventually you take after-tax dollars out, but it grows tax-free. So
Right.
that's what a 1031 exchange. So we start talking to them there, and we'll say to people, this is how we do it. You could go out and you're going to sell one property, but and you don't want to pay taxes. But if you buy another investment property where you're still the landlord, what have you accomplished? Maybe it's a bigger property with a little more income, but it's just bigger headaches. Again, what is your objective? It is to enjoy life. It is my life goals. And so you start talking to them. So the way that it works is then we help to build a diversified portfolio of individual interest in large portfolios of institutional real estate. And what we're doing there, it's all perfectly, I won't say perfectly, but it's tax efficient, and it's tied to the individual's specific tax situation, what their basis is, their state, what their properties they're selling, and what they're reinvesting in. And we're maximizing in those portfolios after tax risk adjusted returns to the individual investor. So somebody will look at them and they'll say, I'm selling this office building that my office or my business used to be in. How much are you actually making every year after tax? And you'll look at it, and they probably run out of depreciation, and they're making 3 or 4%, something like that, on the value of the asset, on kind of cash on cash. Well, if we can take them from a concentrated position where they're getting 3 or 4 or 5 and put them into a sheltered position where they're maybe getting 5 or 6 pre and after tax, so fully sheltered. If you think about that sort of on a tax equivalent, kind of like a muni, that's like an 8. And so you're going to get, sort of a 7 or 8 tax equivalent based on your tax situation. And that's based on ownership in 40 properties in 12 states, 10 states, 14 states, completely diversified. We've completely changed the risk characteristic of the investment from one property in your backyard that you're running that could literally go vacant or burn down tomorrow, to a diversified portfolio managed by other people that on an after-tax basis is sheltering 100% of your income or near, and sending you checks once a month. The risk profile and the outcome, and frankly, the ability to hit or accomplish lifestyle goals for the people that we serve is immense. It's immense. It is truly one of the greatest wealth building and transfer tools that families use, investment properties are, to move money across generations. And that, frankly, is why so many big family offices, some of which we're talking with right now, that's why they use real estate as a tool.
Yeah. And so how does that translate into an investment advisor, financial advisor relationship, right? So you've got a client who has a real estate concentration. They come to you, they want to do a 1031 exchange. w- What's kind of next? Are you actively saying, hey, you need to go talk to an investment advisor here? Or is this a scenario where a financial advisor found a client who has a large real estate position and they've got to bring that to you? Or I guess both could work. But what is the process from there so that the advisor can get that integrated into their business, that relationship integrated into his or her business?
Great question. So behind the scenes, and again, this is some of the knowledge that I've picked up as a recovering real estate guy. Um, we have built an offering that is high touch, concierge offering that is driven by technology behind the scenes that does this portfolio construction. In essence, what we have built over the last 4 or 5 years, and we're rolling it out right now um, to RIAs and to broker dealers, but primarily RIAs, is an investment property turnkey asset management platform, or TAMP, a real estate TAMP. So if you think about the way you're using a TAMP, whether it's SCI or InvestNet or InvestCloud or whoever you're using,
Totally should be
it's
using
helping.
InvestNet, just say.
I again,
We produce a show for an InvestNet property. I'm just saying they should use InvestNet. That's like
perfect. So you got your plug in.
There you go.
But it's a turnkey asset management program for real estate. And so the way that we built this technology, because it's extremely complicated what we're doing behind the scenes, all the risk quantification, that
Yeah.
how the sausage is made doesn't matter. Somebody comes to us, an advisor, and they say, "I've got a client with this problem, investment property wealth problem," and we say, "Great. How do you want your client to work with us, or how does the client want to work with us?"
Yeah.
Because again, we're in financial services. Do you want to work on and I'm not suggesting this, but you want to work on a commission basis where we'll help you to build a portfolio and buy these securities. These are private securities. Everything
Hmm.
that we do is they're private placements, albeit large private placements. Do you want us to help build the portfolio and do that for you? And then your clients are good going down the road. That happens occasionally. What we really were missing, and we realized has developed this and rolled it out again in January, is a true fiduciary type solution. So that's what we have built, where we had to figure out as a company, how do you do valuation on literally hundreds or thousands of properties, and how do you do that objectively, and how do you mark this stuff, and then how do you collect on it, and then uh, how do you how do you how do you custody this stuff? How do you
Yeah.
collect on it? How do you tie it into a black diamond, or how do you tie it into an InvestNet? So we figured all of that out. So we can do it on a commission basis. But the real key is, and this is revolutionary, we built a full true fiduciary solution for investment properties. So it fits. And that's what becomes really interesting. So a lot of the RIAs we're talking to, they may say, well, I am an upfront fee-based planning advisor. Okay, great. So let's talk with your client. You need to establish what we're going to do in the planning process. We'll help you with that, and our objective is realized is to help that advisor to look incredibly or to be incredibly smart and knowledgeable in front of their clients. We
Yeah.
are never going to step in front of that advisor unless we're asked to step in front of that advisor by the advisor themselves. So how do you want us to work with them? Do you want us to interface directly with them? Do you want to be us to be the sub advisor and you're the primary advisor? We can be the advisor, but sort of held away assets, we can do it that way. So we have total flexibility upfront, AUM, sort of ongoing fee, commission based. We've created the flexibility for real estate to fit into wealth management in a again the same way that you would think about other asset classes. So a lot of times the advisor will say, okay, I want to do this on an AUM basis. We've got tiered service levels, tiered pricing. Okay, so we arrive at what Realized is going to do, or what sort of arrangement we will have with the client or the fee on doing acting as the sub manager, and then if the advisor is also collecting on that, we build up the fee, and then we go to work and we work with them, building their portfolio, helping them through the transaction, helping them through a 1031, and then we just manage that wealth quarterly, doing quarterly valuation and updates and annual reviews, and I mean all the things that you would normally do, using our secondary market where possible to go out and help liquidate positions on historically illiquid assets. So it's interesting because one of the things you have to be able to do is active management. We're actively managing a lot
Yeah.
of real estate, which frankly in this environment like we're in today, you need an active manager.
Yeah. I love the fact that you hit the elephant in the room right in the trunk, if you will. It's like, hey, listen, one of the things that advisors we talked about earlier, why do we think that financial advisors haven't been advising on real estate investment portfolios prior to this? Part of it's knowledge and it's out of their skill set because they weren't trained to do that. The other part is like they have no idea how to make money off of it. Let's just be blunt, right? Like, why do they not advise clients on investing in startups or other things? Well, because they have no idea how am I going to make money? That's not what my job is, right? So now we have solutions. You've hit that you could, however they choose to make money and or fee their clients, however they choose to have their business model working, it can work with Realize, which is really fantastic because if it's got to be a really arduous shoehorning in, you're going to have very little traction here. Um, so we're getting close to the end here, and I want to make sure I ask the big question in the room is going to be, how do I get started? If I'm a financial advisor, a lot of the things that you've communicated so far make sense to me, right? So many advisors are using, outsourced portfolio managers to actually, construct their portfolios and so forth. And there's a fee share arrangement. The advisor is a lead advisor and there's a sub advisor. That's the portfolio manager who has discretionary authority on the accounts and can do the trading and all that type of stuff. They get that. How do they go about structuring the working with, realizing and just getting the ball rolling?
That's a great question. So the first place is our website is realize1031.com, which I don't think is the best way, but it's a good way to begin to get familiar with some of the things we're talking about. The next is reach out to me or reach out to our biz dev B2B team and just have a conversation with them about how this works. We're doing webinars. I'm actually speaking next week at the New York RIA conference, and I'm also speaking at the Gladstone conference. So
Okay.
you're going to start to hear much more about this, and give us a call, and let's just talk about it. One of the things that Realize does, and we've always done this, and when I said this earlier, this is philosophically who we are. If the client wins, we win. Period. No matter what.
Yeah.
And that is who we are. And frankly, if that is not just our client, but if the advisor wins, we win. So if they want to call and have a conversation or join a webinar or participate and begin to understand the nuances of this, we're happy to begin to explain it. It's not going to be salesy. It's going to be informational because, again, the advisor needs to be comfortable and they need to be trusting of us that we are not going to we're not going to put their existing business and relationships in jeopardy. They need experts. That's what we are. We're real estate experts who understand kind of how wealth management works, and that's where they work with us. And we'd love to have conversations. We're having all kinds of conversations. Again, individual RIAs, sort of one-man shops, and we're talking to, frankly, a couple of the largest RIAs in the country, some of the biggest aggregators in the country, who all of a sudden see, what is the next blue ocean opportunity? Oh, this is an interesting one. And it's turnkey. It's a true turnkey TAMP solution.
I love it. I love it. And that's what made me feel comfortable and confident about having you on the show. Is we really try to steer away from product oriented stuff coming on the show. And maybe if there's technology solution, we come on and we try to showcase some new interesting technology solutions. But in this case, this is, to your point, it's broadening the capability of an advisor's ability to serve their clients, right? And let's talk about what that looks like. This isn't really product, right? This is, hey, a solution and an opportunity to expand. Fantastic stuff. We will make sure we get realized all linked up on the show notes for this and so forth. Where else should people follow up with you?
Well, they're welcome to reach out to me. So they're welcome to call me. My direct number is 512-827-3650. I'm the CEO and founder. We have 60 or 70 people in this company right now. And so they're welcome to call me and I can help them with this, or I can direct them to the right person to talk with. But let's have a conversation. I mean, let's just learn more about this and see if it fits. And if it doesn't, that's okay. And if it does, let's go help each other.
Fantastic. Well, David, this has been an amazing conversation. Thank you very much for coming on the show.
Thanks very much, Mike. Have a great weekend.
You too. Thank you very much for listening to and or watching this episode of the Modern Financial Advisor podcast. It's always great to have you with us. Huge thanks to David Wieland from Realize for coming on the show. I really appreciate him and his team pushing the industry forward. I think 10 years from now, it is likely that every RIA will offer some form of investment property portfolio advice, as well as other asset classes such as small business equity holdings. It's really cool to be here for the beginning of this new chapter. All right, as I mentioned at the top of the show, please make sure you subscribe to the podcast on your preferred platform if you haven't done so already, and give the episode a share on LinkedIn, Twitter, wherever you hang out, Facebook. Chances are, if you like this episode, people in your network are going to find it interesting as well. So let them know. Okay, that's it for today. As always, be nice to each other. We'll see you next time on the Modern Financial Advisor podcast. See ya. Bye.